Hello, everyone. Thank you, everyone, for
Um,
joining. How's it going, Michael?
Very well. I hope you're having a good day.
So far, so good. So far, so good. Maybe we quickly introduce ourselves while people make their way in.
Yeah, perfect. Michael Chu, Head of Investments at Sarwa. It's a pleasure to be here on a nice August evening.
Thanks, Michael. My name is Faisal Abdushakur, part of the advisory team at Sarwa. Um, Joining you from hot and humid Jeddah, Saudi Arabia. Michael, you have an interesting summer. Maybe you could tell us quickly about it before we get into the juicy stuff.
Yeah, I am currently in the UK. Been here about a couple of weeks now. I think that's not the interesting part. The interesting part is my wife and we drove here from Dubai. Uh, about 47 days later, 22,000 kilometers. We hit 24 countries and about 36 border crossings. So, yeah, that
Wow.
was the interesting part to get to the UK.
Nice. Thanks, Michael. All right. So, again, thank you everyone for joining. Today's topic is about the psychology of money, why we spend, save, and stress differently. So today isn't going to be about, market movements or the latest hot stock. It's essentially going to be to understand ourselves and why, smart people, including ourselves, sometimes make not so smart money decisions and how being aware of these patterns and these biases can help us do better. So think of it as a conversation about the human side of finance.
Hmm.
The part that spreadsheets and maybe numbers don't really capture as well. And before we get into the meat, just a few disclaimers. So neither Michael or myself can tell the future. Um, no one can for that matter. So we can't predict what's going to happen in the next a few months or years. Our views should not be interpreted as one-on-one advice. Please always do your due diligence and know that all investments carry risk. And with that, we shall start. So the emotional side of money. So we like to think of money about in terms of logic or math. You earn, you save, you invest. Simple formula, right? But in reality, money is personal. It's tied to your upbringing, your experiences, even your identity. And because it's our hard-earned money that's on the line, stakes feel high, and every decision carries weight. So this is where behavioral finance comes in, basically the study of how our thoughts and feelings influence financial decisions. So a couple of examples here, anchoring. So an investor often will fixate on the initial price observed for an asset. So if a stock was previously priced at $100 and is now $70, it may appear to be a bargain, even if the underlying fundamentals haven't improved and or even deteriorated. So that $100 becomes an anchor, right? It influences our perception of value regardless of the performance. And then second, we have loss aversion. So the pain of financial loss psychologically is way more impactful than the pleasure of an equivalent gain. And this bias can lead investors to avoid risk entirely or even panic sell at unfavorable times, which would be driven by the desire to prevent further losses. And then on the flip side, on the third point, would be overconfidence. So after one good investment or after a lucky streak, uh, we start to believe that we've got the right formula or the secret sauce. And that's when, further risk creeps in. So we start believing we have a special knack for picking stocks or picking winners. So we take bigger risks without applying the previous amount of research or caution that we had previously applied. Recognizing these biases doesn't mean that they disappear, but awareness can give us a better chance to make decisions that will serve us better in the long run. Which leads us to our next point, understanding money personalities and how it shapes your habits. So, Michael, want to take us through that?
Thank you. So we essentially have five money personalities, and these can vary. So we get the slide back. There we go. These can vary from you being 100% in that personality, or you can be a mix of different personalities. But these are generally five of the ones that we see most. We'll start with this saver. This is a person or a personality that likes to save and accumulate money. They're diligent with tracking their expenses. They avoid debt, and they prefer safe investments. And they like to have strong financial buffers, but they may miss opportunities and they have difficulty spending. The spender is the opposite. They enjoy money. This is your YOLO personality where they like to upgrade their lifestyle. They have the newest iPhone and they can't wait for the next iPhone. Um, and they have memorable moments. That's what they like spending on. Um, Enjoys the present, and they run the risk of being in debt, and they generally have low savings. We have the avoider, which avoids money stress. So this is kind of like your ostrich with the head in the sand. When it comes to money or anything related to money, they just hide from it. So they don't pay attention to bills, they don't budget, they don't plan. They just live day to day and kind of hope everything manages itself. So that's how they avoid this short-term stress. But as we know, if you do that long enough, it's probably going to be long-term stress that you face, missed deadlines, missed payments, missed everything. So everything gets put on hold and they just avoid. Security seeker. These are, probably a variation of the saver, but they just need certainty. They don't like ambiguity. They don't like the unknown. So they choose insured products. They research everything to death. So they want to know everything, all the nuts and bolts and how it works and what the outcome is. And they're very resilient in downturns because they've done extensive research, but that research takes time. So they often find themselves in analysis paralysis or paralysis by analysis. So they're so stuck in the numbers and the T's and C's that they don't take any action and they just sit on something and the opportunities miss. So they tend to underperform because of the extensive analysis required. And then we have a risk taker. Um, this is your meme coin buyer probably. They seeks the opportunity. They're looking for 10x, and they're happy to do so. They want the volatile assets. They maybe start a business with their friends that seems like a good idea, but they're looking for high returns. And their downfall is often overconfidence, and can potentially lead to large losses. And as I mentioned, you may be 100% in one of these. They may resonate more to you, or you could be a blend. But these are generally the five personalities we encounter, and we probably have strong ties to. So we have a poll, if we may. So let's see where our audience ranks in these different personalities.
Let's do it. So we'll launch a poll in a second. You should see it on your screen. Michael, can you see it on yours?
I can.
Wonderful. We're already getting some responses. Lovely. We'll give it a few minutes. Curious, where do you fall on this, Michael? I was thinking about it, and I think I have some qualities and traits, mainly I would say from spender and security seeker, but also a little bit of risk taker.
I would say I would probably find myself in a risk taker, and it's interesting, maybe in between a saver, a risk taker, and a spender.
Okay.
So I find myself with those tendencies where I want
Yeah.
higher returns. I like to save because I don't like to spend on frivolous things, but I do like to spend on things I value. So I'm in between all of those, I think.
Yeah, yeah. I think we should have made the poll answers multiple choice as opposed to a single choice.
I think so.
Um,
I think that would give us some very interesting results.
yeah, yeah. So, well, 71% have answered. Maybe we give it just
Mhm.
a little while longer.
So we do see a lot
Already,
of people gravitating to that savor.
yeah, yeah. I saw someone click on spender and then withdrew it and then put it somewhere else.
it, there's nothing wrong with being a spender. I always joke with my wife. She's definitely more of a saver than I am. I'm a spender, and the running joke is if I gave her $10,000 to go to Dubai Mall, she would come back with change. I, on the other side, would come back asking for more because I can find anything to buy.
Yeah, I would not come back with change for sure.
100%.
All
But
right.
it also depends on what you're spending it on. So
Yeah,
if it was camera gear,
true.
she would definitely spend that all of it.
My first stop would be the Apple store, knowing myself. All right. I think we have enough responses. Should we share the results?
Yes, I think we
All
should.
right. Let's do it. Ending the poll. All right. So majority of you all have, or 40% actually, have identified as a saver. None have identified as a spender. One of you did, and then withdrew that claim. 13% avoider, so 27% security seeker, 20% risk taker. Would you say, Michael, this kind of more or less falls in line with the, I would say, the norm or the average within our region?
I so I'm going to be a little bit humorous and a little bit cheeky right now. It is a Thursday evening in the summer. All the spenders are outside having happy hour right now or enjoying the sun. This is the people that are sitting on a webinar fall in the savers and the avoiders. I think this poll is very accurate for the audience we have right now.
Fair assessment.
But if you were going to ask me in the region, I would say a lot of the majority of the clients that we've interacted with, they may tend to fall into that spender category because
Yeah,
Dubai is very easy. The UAE is very easy to spend. There's access to spend everything, and you can spend on
yeah,
anything and everything. So I think this poll might be a little bit skewed given timing and where we're sitting. So quite inaccurate. But then what we're seeing is that a lot of clients are in that saving mode where they
yeah,
do accumulate a lot of savings. And what we have seen in the past is it kind of leads to just sitting in cash accounts or savings accounts or maybe they're saving for a large purchase, but it probably could be optimized a little bit better.
yeah, absolutely, absolutely. And just a note for everyone attending, please feel free to add your questions in the Q&A function at the bottom. We'll
Hmm.
get to the Q&A at the end of the session. But Michael, on that great segue to our next section, let me close this guy here, which are emotional triggers,
Hmm.
which is very apt and very, I would say, a good segue from the last part. And generally speaking, so once you've identified your personality, and the next spot is essentially spotting the emotions that tend to drive your decisions. And there are four big ones, I would say, when it comes to money: fear, confidence or overconfidence, shame or guilt, and avoidance. And fear, I would say, plays a huge role. So in your last example, Michael, someone would want to play it safe, which can cause them to lose out, which will cause their money to lose value with time, or they won't maximize their gains. In the example you mentioned, someone would just tie up all their money in a savings account and sits in cash. It feels secure, it gives them the peace of mind, but over time it starts to whittle away and lose its value, with inflation in the background.
Hmm.
And when it comes to confidence and overconfidence, as we mentioned earlier, right? This can be detrimental to your overall strategy. But at the same time, having the right amount or the right level of confidence can help you take the right opportunities, right? Just having too much of confidence, being overconfident, can lead to very, risky, reckless decisions.
Hmm.
In the example I mentioned earlier, you after a few good investments or a few lucky streaks, you start to believe that, you have a knack for finding winners, and you start to take bolder bets, not putting in the same amount of effort or research, and it can backfire, really in a bad way, without having that underlying understanding of the asset itself.
Uh,
Shame or
I,
guilt? Yeah,
I mean, just to
go for it.
extend on your confidence, and your examples were
Yeah,
exact. We've had markets all over, global markets just going up. And let's just take Bitcoin, for example. We have seen Bitcoin just explode, but it's
yeah,
volatile. Would you put 100% of your wealth in Bitcoin, even though you can have these monstrous gains? Some people are okay with that. But
yeah,
those people understand that you can be up 100% and down 100% in the same week. I mean, not now, but it has happened in the past. So that's exactly what you have to be prepared for, is understanding what you're getting into, not just following your friend's advice because they're buying random meme coins and they've tripled in value, and that's going to be their retirement fund. If it goes well, great. If it doesn't go well, then it's about sizing your positions as well. Not all of
right.
it.
Right, absolutely. I can think of just a few people within my circle that, you know, have this outlook, have this attitude towards crypto, all in. That's literally the only investments they make. And then they've been humbled by, you know, the crazy roller coaster cycles of crypto. And a minority of them still hold fast and still essentially double down on that position, but a lot of them have, you know, withdrawn and say, you know, this roller coaster is not for me. So
Yeah,
yeah, really know what you're getting into, right? The third component I would say is, or emotion, shame or guilt. And I think this is a really tricky one. And even I would say relevant to our region, I think this is more potent in that talking about your money, talking about, you know, if you've had a bad experience with regards to investing, or if you've, you know, racked up debt unintentionally, there's a lot of shame, and I would say it's quite taboo within our region
hmm,
to sometimes talk about. You know, the bad decisions or the bad wage that the investment has paid out, but it's important to acknowledge those feelings, and important to kind of separate those decisions from all that guilt and shame, and look at it objectively, right? So if you feel bad about a past mistake, it doesn't mean you should avoid the conversation entirely and not go into investing altogether. So it's important to acknowledge, you know, what went wrong, how the mistakes that you've made, but also learn from it and carry on.
absolutely.
Um, yeah. Um, which leads us again, I think this is also ties into this, which is avoidance, right? So just if you, it goes similarly to whether it's a bad investment or it's, you know, debt, and you just kind of push it to the side and don't check on it, say, "Oh, it's tomorrow's problem, feels overwhelming, I'm not going to go through with it." um, that can be detrimental to you in the long run. It gives you peace of mind, or it gives you, you know, the ability not to worry about this now, but that essentially emotions start to rack up, and then it'll come back and bite you in a more harder way. Um, so these are emotions I think are very normal, usually associated with when it comes to money. But the problem is not having these emotions, but looking at your money only through these lenses, and not uh, 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 taking them head on, dealing with those emotions, and looking at how you can go beyond them and move past them. So yeah, these emotions are normal. And it's when we identify them and know what they are, is when we can move past them and avoid further mistakes in the future.
You're absolutely right. I mean, I think you, me, everybody has gone through all of these
Yeah.
emotions that you've listed. And you pointed out in this region, I think there's a lot
Yeah.
of probably more of the shame, guilt associated with finances,
Mm,
where people feel pressured to overspend, overextend,
mm,
just to keep up this persona of I am successful.
yeah.
I remember, a lot of people get into this trap. They come to Dubai and they overspend because everybody's out brunching. Everyone has the newest iPhone, a fancy watch, fancy
Yeah.
car, and at the end of the day, they end up leaving with little to no savings because they've
Yeah.
overextended, or worst case, they're in a pile of debt and they can't leave the country because they got into this trap. So it's really important to understand where you're trying to focus on. And then actually we're going to be talking about that in the next slide.
Perfect segue.
Yeah. So, I mean, you might be able to tell, so I really like this topic because
Yeah,
we speak to our clients a lot about, what's worked for them and what hasn't worked. And, putting these simple things in place really helps a lot of our clients. If you ever get a chance to read the book Atomic Habits, it's a really, really great book. You might even be able
yeah,
to just ask ChatGPT to give you a summary, and there's a lot of simple tips to get you doing a lot of mundane type tasks into bite-sized habits that you don't even realize you're doing. And so this part of the process is building these resilient habits. So we're moving from reaction to reflection. So all of us like to buy new things, but we're moving from that impulse buy to a structured approach. Instead of saying, I see it on TikTok or Instagram, I'm going to buy it. Then my most people, it's great. That's how they get you. But it should be, I see it, I find it somewhere, maybe find it on Amazon, park it into your shopping cart, and reevaluate a few days from now. It's like, hey, did I really need that pink unicorn stuffy? It looked really cool, but I have no use for it. And then you just kind
yeah,
of get rid of it. But it's just taking that time to move from reaction to reflection. Um, Automating the good habits. This so one of the personas we saw was the avoider. Automation would solve a lot of their stress with anything finance related. Most of us can probably have already automated a lot of their bill payments. Anything that comes through, it gets automatically debited from or either a bank account or a credit card. But what we often fail to do is automate the investing part. One of the most straightforward and basic things everybody should probably do and incorporate is an automated savings program or an investing program. So it's you probably hear it. We've said it many times. It's pay yourself first, allocate 10, 20, 30% of your monthly salary towards an investing goal. Um, Creating that habit means that you're automating it. Markets are going up and down. It doesn't matter. You're investing the same amount every month at the same time. So you're just going to get the advantage of dollar cost averaging, and you're going to be in that habit. Your bills are going to be paid, your investments are done. So you've just now made your life simpler, and you don't have to worry about being that avoider because you automated it. It's not avoidance, you've just taken it off the table. So you can enjoy doing regular things. Reframing limited beliefs about money. So a lot of clients or people we've spoken to says, oh well, I don't really like this financial planning investing stuff because I've never been really good about with money. We're generally not good with money because we've avoided it. We've just said we're not good, and that's kind of the blanket statement. Um, if you talk to my wife, they'll say I'm not a good communicator, maybe because I don't want to communicate. So a lot of things we don't want to be good at finances because we don't want to be good at money. We just rather do
yeah,
something else. But we'll find
yeah,
that things that we are good at, maybe if a sport or a hobby, you can reframe certain things. Instead of I'm not very good at money, is that I'm learning to be better at it. So I'm learning to be better at playing football or golf. I'm not great, but I want to be good. So that's just reframing that mindset. So I want to be or I want to improve instead of just shutting it down and saying I'm not good with money. And mindful spending. This comes back to that reaction, impulse, everything. If we had unlimited funds, we would probably buy everything. Everything we see on Instagram, TikTok, I would have a garage full of everything. But we do have to be mindful with that spending. Spend with purpose. Like I mentioned, I see something I like. I usually park it in my shopping cart on Amazon, and I will leave it there for a while, and then come back to it when I think, oh, well, either there's going to be a deal coming up, or a credit card deal, or anything. I'll wait unless it's something I need immediately. I'll wait until there's an opportunity for savings opportunity. That'll be either a discount, a store promotion, an online sale. So it comes to planning those especially those larger purchases where it makes a difference where you get 5 or 10% off. So that mindful spending, and just I know we talk about, or it's good to budget and spend. Um, there are so many apps out there to help budget and spend and save, but if you don't want to do that nitty-gritty process, just simplify things, pay yourself first. So your 20% investing, that's gone. If you take care of just that 20% and invest in yourself, you can pretty much spend everything, and you'll at least have a good pot by the end, 10 or 20 years from now. But if you want to be that nitty gritty saver type and spreadsheet and analyze that, this will work for you, because then you're maximizing, your investing, and then trying to minimize your expenses. Um, Tying financial goals to personal values. This is important because it's really easy to say, I just want to save. But if you tie it into something, it makes it a lot easier to say, this is
Mm,
going towards this goal. And this will
mm,
help me, either retire early, fund an education goal. And that's what will make me happy, instead of maybe just saying, I want to save as much as possible. So being able to tie the financial goals to personal values, I think it means something to a lot of investors, where it's not just this ambiguous pot that we're filling up. It's a personal goal or value that makes a difference. And throughout the process, if we're visual type learners, or people, find a way that we can visualize that goal. I think it's easy to say, I want to see my account grow from X to Y, but old school methods would be filling a jar with, you know, jelly beans or something every time you did something or added to your savings. So finding these visual type cues is also helpful in reinforcing the goals, because everything's kind of abstract until you
mm.
see it.
Absolutely. Absolutely. Thanks for that, Michael. We're going to take a bit of a break here, and we'd love to hear from you guys. So if you drop it in the Q&A function, again, any question that you have for Michael or myself. Also, we'd like to hear, what emotions you associate with money today in particular. So if you want to drop it in the Q&A, we'll get to it in just a moment while we go through the next section, which is how can Sarwa help uh, when it comes to money, or managing your emotions when it comes to money. So Michael, you just mentioned a lot of great things, right? Automations, right? We have a lot of tools and solutions
Mhm.
that help you automate, whether it's in setting up an auto deposit from your bank or a standing order from your bank. You can do this seamlessly within the app by syncing your bank account. Or if it's setting up an auto trade, you've identified a stock or an ETF that you wanted to trade regularly. So you can set up an auto trade that, basically streamlines the process, removes that avoidance that you were talking about. Um, Whether you wanted to, revisit your goals, or settle or build your goals, you can always speak to an advisor. You can have a call with an advisor where you can chat through those goals, work through your objectives. We can then come up to a solution or a plan that works best for you. And also, you mentioned the visualization, right? And I think there are a lot of components within the Sarwa app that help you kind of visualize or see, how that goal is being achieved, right? We have retirement calculators. We have, a simulation that you can use for your Sarwa Invest account that shows you what the progress of the portfolio will look like given you've maintained a certain level of funding in a certain period of time. So there's also a lot of tools within the app or the website that can help you visualize your goals or objectives, or just seeing your money from a different lens. Um,
Absolutely. And to talk about that, I guess the whole premise behind Sarwa is to make investing easy. It's just to
Yeah.
to take away those friction, the pain points that a lot of investors and clients have faced in the past. You know, funny story, but not so funny, is I remember having a conversation with a friend in 2010 about buying Bitcoin and just putting $100 into it. And he showed me the process, and I think at that time it was probably at least a 10-step process. You had to open certain custody accounts with different places,
Mm.
convert certain things, and then transfer things back, and just to enable you to buy Bitcoin at that time. And I looked at it and said, no, this is way too difficult. Had I actually gone through the process, it'd probably be a different story now, and if I held it, but that's neither here nor there.
Yeah, absolutely. Absolutely. We've got our first question. Want to start tackling those, Michael?
Yeah.
Let's do it. Okay. So Anonymous asks, how do you manage knee-jerk reactions on investments when it comes to market downturns? It's a good question, Anonymous.
It's
Thank
a
you for
great
that.
question. We get asked that question all the time,
Mm,
and market downturns happen quite frequently.
mm,
Sometimes more frequent than we'd like. But the reality is, it is that knee-jerk reaction, and we generally want to take that emotion out of it. And in fact, if you are set up on a monthly investment plan and you're putting, X amount of dollars every month when you get paid, this type of volatility is 100% in your favor. So if the market drops by 30% and you're expected to make your contribution at that time, you've just got a 30% discount on every stock or ETF that you're planning to buy at that time. The challenge is if you're coming close to retirement and you need to draw down on those funds
mm,
and you're facing that downturn, that's where it
mm,
gets a little bit trickier. So, when we're working with clients, we want to manage that transition from growth to income phase and make sure that there's enough income or liquid investments when they need to draw on that. But during the growth phase, as long as we have 5 to 10 years to go, market volatility is your friend, especially if you're still investing and deploying capital.
yeah, absolutely. I always mention this in my conversations with clients is that you want a market downturn to happen. The earlier you are, the more you want the market to go down. It's not going to work for you now, but it will work for you down the line. As you said, if you're still actively contributing to your portfolio, then great. You're getting a discount essentially, given you're applying, you have a diversified portfolio and whatnot. Um, so yeah, market downturns can work in our favor, not in the short term, but rather in the long term. And really, when there is a market downturn, there's three things you can do. One is do nothing, wait out the storm.
Mhm.
Two is you instead of investing 500, you invest more. You invest, you seize the opportunity. And three
Yep.
is you panic, right? You say this is not for me and you exit, right? So ideally, you want to be either one or two, or do nothing, wait out the storm, or seize that opportunity. Uh, Panic selling during market downturn is probably the worst thing you can do, especially
Mhm.
if you've still got a long way to go.
Yeah, and we found that this past April, um, a lot of our clients took that opportunity to add.
Yeah.
We didn't see a lot of panic selling because I guess the dynamics around why the downturn happened in April and the volatility. I think most of our investors understood that it was politically driven primarily, and
Mm.
that it wasn't a fundamental problem with the global economy. Yeah, so they definitely took that opportunity.
Yeah, thanks for that point, Michael, because our last webinar was, or maybe not the last one, the one prior to that, was focusing on the data and where we kind of shone a light on how investors performed during 2025. And interesting enough, exactly what you mentioned, right? So during April, instead of holding back or even exiting the market. No, we saw our clients double down and even fund more, invest more. And I think it kind of goes into the reasoning behind what you're saying is fundamentally things haven't changed. The macroeconomics didn't really change. It was more of a kind of political play there. So maybe that's why. But at the same time, I think our clients and our investors have maybe reached the level of maturity or reached the level of understanding that they saw an opportunity and they seized it.
Yeah, it's right. I mean, a lot of our clients are also invested in big tech, and
Hmm.
most of those tech names took a bit of a hit. But we
Right.
look back now and look at where most of those Mag 7 names are.
Yeah.
It's significantly higher than where they were in the lows in April. So good
Right.
quality companies with a good outlook will tend to do well.
Mm.
Defensive sectors, defensive names, or broad-based market ETFs like the S&P 500 or the MSCI World. These are so diversified that it would really take an apocalyptic event to zero out majority of those companies in those indices. So um, broad-based is great for clients that want diversification. Clients that want to be a little bit more focused in single name stocks, they just have to be careful with sticking with good quality, very
Mm.
liquid, probably large to mega cap names to ride out any kind of volatility and downturn.
Yeah. I don't see any other questions, so maybe I'll ask a question of mine. Michael, you mentioned, and I like this strategy, and I've heard it before in different variations, wherein you would add something to your cart, and before bu buying that item, you'd have basically have a cool down or a period wherein you think twice or think about it before you make that purchase. Would you say that same tactic or that same strategy could be applied to stocks, especially if maybe you're a little bit of an active trader? And if it does, then on the flip side, so if markets are tanking and then you instead of you immediately or markets are soaring, and instead of you taking immediate action and just hold off a few days or a few hours, wouldn't that mean you miss out on that opportunity?
You can. So I guess the question we have to ask ourselves is what is motivating us to buy that stock or buy or
Mm,
sell that stock? Are
mm,
you buying it because everyone, your friends, and everyone on TikTok is saying you should buy this stock or this meme coin? That might not be the best idea because then you've just fallen into the hype and the herd. Now, if you still want to consider that, I mean, if you're fine with just throwing a little bit of money, but if you're going to be adding, a significant portion to that stock or ETF, I would always suggest to do a bit of homework and understand, at least the dynamics of what's driving the upward trend. And to be honest, a year ago that might have been a little bit more difficult, but now we have, you know, uh, a multitude of AI tools. You don't even need specialist tools. You can feed this through Gemini, ChatGPT,
yeah,
Perplexity, anything. Say what is driving Bitcoin to be, reach all-time highs, or what's propelling the Mag 7, and what are some of the risks? And if you just take that approach to do a little bit of work on understanding what's driving a lot of these upward movements and potential risks, then you're a little bit more informed about what you're getting into instead of just say, hey, Joe told me it's a good buy and I'm going to
yeah,
go all in.
yeah. True, true.
Yeah. I mean, back in the day, that it probably would have taken you days to do up some
Yeah.
research. You're going to, look at the company reports, financial statements. All of this can be done probably in a half hour sitting with all the AI tools.
Another plug for one of our past webinars. Michael, you did a really good webinar. I forget the name of the guest speaker, but he kind of walked us through, the stock screening and selection process with the use of AI and how it expedites that process. It cuts it dramatically. Um,
Yeah, that was our past. I can't remember the name, but it was. believe it was Brian. He was a contributor to the Motley Fool, which is one of the
Yeah,
online resources if you're looking for research. And he outlined his process about what he's looking for, and he also reiterated that it's almost inexcusable that you didn't do the homework because the tools are there. And for a
yeah,
seasoned pro like himself to do a lot of his work. Now, I had an offline conversation with Brian. Said, "Look, the AI tools are as good as the input and the data surrounding it. So it's kind of like you asking a research assistant to do up your thesis, but as the person submitting the work, you need to double check all the figures yourself. But
yeah, yeah.
90% of the work can be done. You just go through it and make a decision on that."
Right, right.
We have a
I highly
question.
recommend. Yeah, I was gonna
Yeah.
say I highly recommend you check out that webinar. It's on our YouTube page, and
Yep.
Michael and Brian did an excellent job. So please check it out if you are interested.
Thank you. We have another anonymous question. Um,
We have two
that,
anonymous questions.
yeah. So, what would be your generally preferred exit strategy for stocks? This type of question can be. So, exit. Didn't you do? You just recently wrote up something about exits. When to exit in our newsletter.
Yeah, it was more about like when to sell,
Hmm.
and pertaining mainly to cutting away your losers or trimming your winners. So
Yep.
in that context, I like this question. It's also a very subjective one. It's dependent on your objectives, your goals. Have you reached your goals? Is that your trigger to sell? Are you is it a time bound? Is it figure bound? Is it 5 years, 10 years? Is it, when I reach 20% or 25% returns, that's when I cut. So I would say it's a very subjective question. And with regards to, trimming winners or letting go of losers, um, which is a very relevant thing because a lot of emotions tie in and play into those factors, right? If you hold on to your winners too tightly, too dearly because of overconfidence or avoidance or whatever, it can come back and bite you, right? Your risk is concentrated. Instead of rebalancing, you just double down on that stock. And when, market corrections occur and market downturns occur, you'll feel that correction or that downturn more significantly. So that's a case for trimming your winners. And then for letting go of your losers, that can even either be like an objective hard stop. You say, if
Hmm.
this position loses 15%, that's it. I'm done. I no longer want to see this position in my portfolio. Or it can be through various other techniques. But I would say recognizing what are your thresholds, your objectives. It should always be in the context and the backdrop of your objectives and goals.
Yep. So, to that point, if you're an active trader, you may set your stop losses at 10% or something. You don't want to see that stock
Yeah,
going
yeah,
below 10% and you want to exit. That's an active trader, so you're going to be buying back at some point. For some of the buy and hold clients, if a position is down by 15%, maybe that's onto your watch watch list, and you're going to be evaluating, looking at some fundamentals, maybe reading up on some analyst report. What is the outlook? What's caused that 15% drop, and is it going to be recovered in the next 12 to 24 months? And that's when you want to make a decision. Is okay, the outlook isn't great. It's down 15%. Maybe it's a coal mining company. Well, the outlook for coal is not great. It's probably one of the worst ideas at the moment. I mean, I'm just using coal because everyone's transitioning to clean energy. So you're probably better to take that 15% loss and
yeah,
allocate to something else, solar, to wind farms or tech or something. So it really
yeah.
depends on what your strategy is and what that outlook for that particular stock or sector is.
A simple addition to this, and this is probably you've all heard it before. It's been said time and time again, but I think it's very simple but very potent and effective in driving that point. Is if you have a position or a stock that's down 50%, that means it would have to go up 100% for you to just go back to
Yep.
where you were. So that's you can't just think of it from the loss perspective. Think of what you would need to go back to where you were or even beyond that.
Hmm. Absolutely.
We have another question from Anonymous. What is the main driver then? Historical trends or company popularity, and what the company does after research? Do you go by gut feeling?
Um,
Hmm.
so a lot of points in there. I, you would actually incorporate all of these points. Company popularity, so that plays on size, liquidity, what they do. Obviously, larger companies have scale. They can tend to perform better in all market conditions. And is the company doing something very specialized, or are they in a general sector where margins can be eroded? For example, are they in a high margin specialized market like Nvidia, where the competitors are there will be competitors, but they're not quite at the scale yet? Or are you looking at a food grocer like Walmart, where they sell a lot and the highest revenue, but their margins are super thin and can be easily disrupted by changes in the economy? And then you kind of tie all those things together, and at the end of the day, you need to make a decision, and that is kind of your gut. Do you like company A better than company B, or are you more comfortable with this sector or this entire market? Do I
Hmm.
like the US market more than the European market versus the Japanese market or the Asian markets? Like all of these things will play into it, and what your research and thesis is, and how you go about looking at all of those factors.
Yeah, and if I may add to the gut feeling part, and of course coupled with research, your insights, and all of the fundamentals, um, when it comes to gut feeling, and this is something I do personally, is I kind of ask myself, do I see this company being around the next 10, 20 years? Do I interact with this company's products or services on a daily basis? If I do, then that is another reason for me to then lean in that direction, right?
Hmm.
This is something I'm familiar with. It's something I believe in. It aligns with my values, something that I interact with on a daily basis. That in itself is sufficient for me, of course, coupled with proper research and insights.
Yeah, and I'll hear that. Probably 2 or 3 years ago, the only people that really knew the NVIDIA name were gamers and Bitcoin miners.
Yeah,
That was it. Gamers knew
yeah,
because they made the one of the best video cards
yeah.
for hardcore gaming. Miners knew because their GPUs or video cards were essential for mining. Now
Mm,
everybody knows NVIDIA as a
true.
household name because ChatGPT, Gemini, and Perplexity all require NVIDIA chips for those high-end data centers. So understanding what you're investing in, and the different areas. I think we've had a conversation about infrastructure. Generally, it's been a boring asset class, but pretty much everybody knows what infrastructure is now because data centers fit into that infrastructure sphere, and data centers are essential to for the AI revolution. We had a quick chat about cloud infrastructure, cybersecurity. These are all the supporting services for the AI boom.
Yeah. It's like the highway or the tollway
Mhm.
for these ecosystems. We don't have any other questions, but we can maybe go, and that was also a segue, Michael, when I mentioned tolls, and you mentioned earlier that you're on a current road trip. You drove all the way from the UAE to the UK. That sounds. I mean, I know bits and pieces of your trip. Wonderful. I highly recommend you follow Michael on LinkedIn. He's been sharing tidbits of his trip. Maybe if you can share some money elements throughout this trip, anything that caught you off guard or any psychological finance stories to share in the next few minutes that we have.
Yeah, actually, thank you. It's been a great adventure. I can say that fuel cost is ridiculously expensive when you get out of the Middle East. We were so spoiled with having fuel costs at what they are. The highest we had to pay was €2, 2.0, 2 euros and 8 cents or something. Yeah, per liter. That's equivalent to around 8 dirhams a liter. So
Oof.
that definitely hurt. And we expected fuel costs to be incrementally increased, and it was just that one gas station that was a little bit higher than normal because we were on a toll highway and we needed fuel. But generally, it's still significantly more than what it was in the UAE. The other one that caught us off guard, I've always known that tolls were expensive in Europe, but they are very expensive. The longer you drive on a toll highway, the distance and time, the more you get charged. So because we're trying to cover a lot of distance, we opted to, in a given time frame, we opted to take most of the toll highways. So that was more expensive than expected. And then they also have these, what they call a vignette system, where you actually have to pay for the days you want to use their highways. So it wasn't a toll. It's like saying, I think Switzerland had is, I need a 1 or 10 day pass to drive on your highway. So, and if you get caught, they send you a bill. But I'm not sure if that fine would ever make it back to Dubai, but I didn't want to chance that. So yeah, it was those expenses, and also because we're driving so much, we tended to have McDonald's more often than we'd like to admit, and we saw the price increase incrementally. And what the sad part was, the price increased, but the quality decreased. So you're paying
Interesting.
more, and it didn't taste as good. So that was the disappointing part.
I think a question maybe on everyone's mind, which was your favorite McDonald's out of all of the ones you tried?
Well, I think McDonald's in the UK is very similar to in taste and flavor to McDonald's in the UAE.
Mm,
Um, yeah, in the Netherlands, they didn't have hash browns for breakfast. I didn't understand
mm,
why. Hash browns kind of make that breakfast meal. McDonald's in France didn't taste very good at all. Yeah, it just wasn't there.
mm.
And yeah, it's sad to say that I can tell you which countries throughout Europe have McDonald's that I like or not. But
Was it safe to say that you throughout this trip were embodying the saving personality or the saver personality, or maybe another
we
one?
we were absolutely, because we were buying groceries as much as we could at
Mm,
Lidl, which is similar
mm,
on scale like Aviva, because it had a good selection of what we're looking for, and it was priced fairly. Um, That being said, yes, fuel cost was by far the number one expense. And unlike
mm.
in the UAE and Saudi, fuel prices fluctuate from gas station to gas station.
Yeah.
So we'd be mindful of which stops we want to fill
Mm,
up at. Um, Obviously, the ones that are right off of the highway or the motorway tended to be the more
mm,
expensive ones, but if you took an exit and drove down into a little town, they
mm,
were probably 10 cents or yeah, 10 cents cheaper or more. But if time is something that you're trying to manage, you just kind of paid the premium and filled up
mm.
on the side of the highway. So yeah, we were definitely trying to be mindful, and we camped a lot. Most
Right.
of the nights we camped, and we didn't camp in campsites. We just camped in the wild. So that was probably a significant cost savings, just because we like camping out in the wild. Uh, Nights that we were in big cities, then we'd probably
Yeah.
look for a campsite or a hotel. Yeah. So we were definitely mindful
Nice.
of
What was your
spending.
total, for sure? What was the total kilometers driven?
Just under 22,000.
Wow,
Yeah,
22,000.
22,000 in 47 days. So much so that we had to stop and get
Interesting.
an oil change in between. because our cycles every 10,000
Wow.
kilometers we get an oil change. So we
Wow.
even budgeted for that. We
Yeah.
brought our
Yeah.
own oil, brought our own filter. I was adamantly against that because it took up space, but my wife and our mechanic said
Mm,
we should take it just in case we need spare oil. And I was thinking every oil change place will have oil, will have our filter. But it actually turned out that a gasoline powered Prado and Land Cruiser 300 are not that common in Europe. Most of the European cars, especially the big ones, are diesel. And so they didn't have the right filter for our friend's Land Cruiser, so they had to use a replacement. But we had brought everything, so we were able to change our oil. We just had to find a garage.
nice. Honestly, Michael, if our viewers wanted to follow up on this trip, what would be the best way to do so? Would LinkedIn be a good place to kind of follow up on the trip?
Actually, I think Rocky's Instagram would be best. It would be maybe her
Okay.
highlight reel. Let me
Do you
find
have
it and
that
I can.
LinkedIn?
Her, yeah, it's underscore. Type it in.
We can probably share it in the when we send the recording. We can probably share it with you guys there.
Yeah,
Highly recommend you follow Michael on LinkedIn as well as his journey across Europe from the UAE. Um, we'll share those details with you in the follow-up
yeah.
email. You'll all receive an email with a recording, and we'll link these lovely and useful resources. Unless anyone else has another question, we don't want to keep you guys much longer. Thank you so much for taking the time and joining. It's been a pleasure. Michael, as always, great, this with you. Thank you all for your time.
Thank you so much and have a great evening, everyone.